Welcome everyone. My name is Nikki Johnston and I'm with Transition Advisors. Our webinar today is Preparing Your Firm for an Upstream Merger. Before we begin, we need to cover just a few important items. First, please close any other programs that you have running on your computer. This will just help to ensure a quality presentation and reduce any audio issues. Transition Advisors LLC is a proud and approved sponsor on the National Registry of CPA Sponsors, per NASBA. Under the new NASBA guidelines, today's 60-minute session will qualify for 1.2 CPE credits. In order to receive those credits, you must complete two requirements. The first is that you participate in all 4 of the polling questions. Those will happen throughout today's presentation. And do note that GoToWebinar does monitor your participation in those polls. Partial credit will be given for those who answer 3 out of the 4 polls. Next, you also need to complete an online evaluation, and this will appear on your screen immediately after the end of the webinar, so please take a moment to complete that before you close your browser. Once you've met both requirements, your CPE certificate will be sent to you by email within 10 business days. Now, in order to fully participate in the webinar, take just a moment to familiarize yourself with the GoToWebinar control panel. You should see it on the right-hand side of your screen. There's an orange arrow near the top, and you can use that to minimize. All the participants are muted, but you can communicate with us by using the question box toward the bottom of the panel. Just type any questions you have and click send. Time permitting, we will answer all of the questions during the session today at the end. Now finally, I'd like to remind you that Transition Advisors offers a free 1-hour CPE webinar each month. We have 2 remaining topics for the year before we break for tax season. In December, we're presenting the urge to merge, and then January will be Back to the Future, a look back at 2016 and some expectations for the new year. You can read more about those webinars and register for them on the CPE courses section of transitionadvisors.com. Now, I'd like to remind you that you received a link to download the slides in the reminder email from GoToWebinar. I also sent that link just now via the chat function, so if you'd like to download that PDF, you can and follow along. If you'd like for me to email that to you, I'd be happy to do so. Just reply to one of those reminder emails and that'll come to me and I can send it to you as an attachment. Now I would like to introduce our presenter for today's session. Terry Putney is the CEO of Transition Advisors. Thank you so much and I hope you all enjoy the webinar.
Thank you, Nikki. Just a little introduction on our firm. We are a national consulting firm that works exclusively with CPA firms on ownership transition issues. So that kind of falls into 3 categories. We do a lot of work with mergers and acquisitions, including searching for partners looking to sell or merge up, and firms are looking to acquire, helping out with the negotiations between those firms. We also work on everything related to the supporting such a transaction, including contract design and review and valuations and deal structure and helping with due diligence and so forth. So in the M&A area, those are the 2 categories up on the top of this triangle here. And then the other thing that we're involved with increasingly is working with firms on internal succession strategies, including helping firms identify what might be wrong with their owner agreement that would make it work better for them, and in many cases helping a firm adopt a new owner agreement for the first time. So we can give you some insights into how your agreement compares with your peers in the marketplace and how it will fit the specific situation that you're in. I'd like to encourage you to, during this webinar, to ask any questions that you might have in the chat function. Try to keep an eye on that and answer those as we go. And the other thing I would suggest is that if you have any questions specific to your own situation and you'd like to have me address those, I'd be happy to do so. Just send me an email. You'll get my email address here at the end of the webinar. And I'd be happy to try to address your situation. And whether or not we're a good source for you for any services, I'm happy to try to provide you some insights specific to your situation. With that, we're going to start with a polling question so we get some idea of the nature of the audience that we're working with today. Nikki?
Okay, the first one is on the screen there. This one is, how many equity partners do you have in your firm? So take just a moment here to answer the question. Again, this is the first of 4 polling questions that we'll have throughout the presentation. I'll leave it open just for about 5 more seconds. I don't think we have quite everyone who's answered. Okay, the results are there on the screen. 62% of the folks on the call are in that 2 to 4 range. 23% are sole proprietors, and then an even split between 5 to 9 and 20 plus.
Okay, very good. There we go. All right. So chances are that you've been approached. I mean, merger and acquisition activity in the accounting profession is obviously at a very high level, historically high level. We tracked probably close to 350 transactions last year that we know of, many of which we were involved in. And that's just, I think that's just the tip of the iceberg. There's a lot of transactions that happen that are never announced, so especially with smaller firms. So chances are that you've been approached by another firm about merging, or maybe you've approached other firms about merging up. Maybe many firms that we work with are actually going both ways. They're thinking about growing through mergers and acquisitions, as well as would entertain a conversation with merging up. Obviously, if you're on this call or on this webinar, you're at least thinking about doing that if you haven't actually had the opportunity to consider a specific situation. I'll try to give you some insights on the call on what to expect as you go through the process. We're going to start with a case study. This is a 3-partner firm, about $2.5 million in fees, and $800,000 in capital is only relevant because of some of the deal terms we're going to talk about. But the firm was made up of 3 partners that are, Frank is 63 years old, and as is the case with many firms like this, probably was the founding partner, and ended up with a substantial amount of equity. As a result, this firm uses the equity method for determining how to allocate value in their firm. So this 70% equity is important primarily for allocating equity in the firm. Alice is 55 years old and kind of an average partner in the firm, manages 1/3 of the business and makes about 1/3 of the profit as far as compensation. And she's not sure when she wants to leave, when retire, but it probably is looking at least 8 to 10 years, if not longer. Dan, a new partner who was brought in recently to try to shore up the succession team, only owns 5% of the equity, which is common for a starting place for a new partner in a firm like this, and manages a smaller book of business, and of course has a relatively smaller amount of compensation. So their buy-sell agreement, which is an important issue in why this firm was pursuing an upstream merger, requires that the capital, remember we talked about that being $800,000 and Frank owns 70% of it, the capital was to be paid in the first year, at the end of the first year. It's not uncommon in an agreement like that. I think it's, in this case, pretty expensive, but not unusual to see that. And the goodwill, which was based on a 1x multiple of the revenues times the equity percentage, was to be paid over 5 years with interest. And of course, the reason why the firm put together that kind of agreement, not that I agree with it, I think it's actually a poor why they did that was because they thought that was kind of replicating what would happen if they were to sell the firm. As a result of this, Alice and Dan, who are supposed to be Frank's successors, are pretty sure they can't afford the payments. They're not, this is very, very significant amount of money. They're not sure they're going to be able to do that. They also don't feel like they have a strong enough bench to replace Frank and all the work that he does. And quite frankly, neither one of them really wanted to be managing partner. I think, Dan probably long-term would be, but felt too new to the situation. So they were very uncomfortable about their prospects of retiring Frank. The goals oftentimes for firms that are pursuing upstream mergers are succession is clearly at the top. If we're involved in, probably over 100 discussions of merging up in a year, a good 90% of them have at least some issue with succession in the firm. I've worked with firms that are as large as 50 million with 25 partners that have succession as the real reason they were in the conversation, although it didn't appear that way to the outside world. Other reasons are expanding reach of special services. You might have developed a specialty in a certain industry and feel like you can access a lot more business if you could get into a larger firm that has more of those kinds of clients. You know, eliminating tasks, undesirable tasks and situations. I would say that most smaller firms, particularly, you know, you're the chief cook and bottle washer, and a lot of things like personnel issues, HR issues, technology kinds of things, or things that fall on your lap that maybe you don't enjoy doing, but there's no one else to do it. So sometimes one way to fix that is to merge with a larger firm who brings those resources to the table. Reducing risk, which comes in many different forms. We'll talk about that in a second. And then, of course, increasing the potential for professional and financial growth, which means, you know, I've kind of reached my limit here. There's only so much I can do. If I was with a larger firm, I could target and focus my efforts more, maybe develop more leverage, staff, the enjoyability of working in this practice, as well as my income. Some of the risks that we find oftentimes that sellers are trying to avoid, one is liabilities to former and soon to retire partners. So think back to our case study and what, you know, Dan and Alice were concerned about. You know, specialized services that might not be sustainable. An example would be you do a certain kind of work, say you're qualified to do audits of government entities and it requires special expertise to do that, and the firm doesn't feel like it can replicate your expertise if you were to leave or to retire. So they need to potentially merge with a firm that has that kind of expertise to build a stronger bench for that special expertise. Lease renewals, of course, you know, you're reaching the end of the lease and you're thinking, you know, maybe if I'm 60 years old, do I really want to sign on to another 5 to 10 year lease, especially if I have to put my name on it. You know, potential lease loss of key employees, for instance, somebody who might have been with you a long time, has a lot of client contact, or somebody who you know, you really depend on, it would be hard to replace if they're going to retire soon. We're finding that sometimes as the catalyst. And then sometimes clients that you have outgrown or have outgrown you, but you hold on to because you have such a great personal relationship. When I was managing my old firm back in the early 90s, we merged in a sole proprietor that had a client the sole proprietor was only about a $500,000 practice, but he had a client that was a $200 million manufacturing company. It's actually a company you've probably heard of, but you know, he knew that he couldn't hang on to that client forever, and that already some of the services that needed to be offered, that he needed to be providing that he couldn't, were being done by other accounting firms. And so one of the main reasons why he was interested in merging in with us was because of this client and his desire to keep that relationship. And as it turned out, we were able to grow the services that we offered the client substantially after the merger. With that, I'm going to turn it back to Nikki for just a second for another polling question.
Okay, the second polling question is on the screen. Which issues do you see affecting your practice most in the next year? This time your options are succession for retiring partners, admitting new partners, client retention for those retiring partners, a need for growth, or you can choose all of the above. We'll give everyone about 10 seconds to answer the question. This is the second of 4 polling questions that we'll have today. The poll. And the results are there on the screen. 36% indicated a need for growth, 29% succession for retiring partners, 21% all of the above, and then 14% admitting new. No one selected client retention for retiring partners alone.
Okay, thank you. So getting back to our case study, the firm that Frank and Dan and Alice are talking to is a 6-partner firm with about $7 million in fees, and that's not an unusual relationship between an acquiring firm and an acquired firm, 3 to 1 roughly. I'd say that when you think about who you should be merging into, that's a good way to think about a minimum. It's not necessarily required to be that kind of ratio, but it seems to work best. One of the big reasons is a firm of that size or larger would have the capacity typically to replace whatever it is you're going to lose. For instance, in this case, it's Frank's retirement eventually. One of the things to think about, and we won't get into this in detail on this webinar, but I'd be happy to talk to you individually about it, is how difficult it is to do a merger of equals. It feels like the easiest thing to do because typically you think, well, the culture of my firm and the culture of that firm would probably be about the same because we're the same size, but the reality is that everything's on the table and it becomes much more difficult to do, and I would say the probability of doing a merger of equals compared to a merger into a firm that's larger than you is less than half because it's so much more difficult to work out all the issues. But in this case, the acquiring firm being a $7 million firm, two partners are retiring, one in 4 years and one in 6 years, and the reason I bring that up is because that was initially an issue for Frank and Dan and Alice was, is this firm going to be able to hold itself together? But as it turns out, as we got into the analysis, we found that there were 4 partners in waiting. So they'd actually done a good job of creating their own succession. And when you look at people leaving and people coming in, and it's not the question of who's going to be there when I need them. It's a question of we'll create new partners that will keep the firm viable and create the capacity that you're relying on as you think about merging into that firm. And this firm knows that it needs to promote partner candidates, but is concerned about diluting the profit pool. So they're trying to stage everything properly. And one of the reasons why they're interested in this merger is because this merger will actually create capacity for the new partners. As Frank leaves, it'll create a book of business and an opportunity for the new partners to grow into their role. There basically are 4 different kinds of deal types when you look at how, when we talk about Upstream merger, we're also talking about sales. So, one is an outright sale, and when I think most people think of selling an accounting firm, this is what they're thinking about, is an outright sale, sort of like selling a car, selling a house, and selling my company. A version of that, though, that I want to get into is what we call a 2-stage deal. You can learn a lot more about 2-stage deals by downloading some of the articles we've written for the Journal of Accountancy on our website. Another is a Cull-out sale, which is a partial sale, and then I'm going to talk a little bit about the difference between a sale and a merger. In an outright sale, to the house, here you go, you bought the house, it's now yours. Of course, you're dealing with a business and you're dealing with relationships, but it's not unusual in an outright sale for the purchase payments to the seller to begin immediately. Well, that causes several things to happen. One is you for the practice. At the same time, they're paying you for your compensation. So your role as a seller has to change, or you have to be, your role isn't going to change. So the fact that your role probably is going to change now affects the transition. It doesn't, all of a sudden the clients are immediately faced with the prospect of you're not there as much if you're there at all. And it can make the transition of your practice a lot more difficult. And that's really the disadvantage of an outright sale. Everything's happening too fast. Certainly from a financial perspective, seems like the best way to go because you started getting paid for your practice right away. But the value of your practice, as we're going to talk about in a little bit, is based on your ability to successfully transition your relationships, client relationships, to somebody else. And if you don't give it enough time, oftentimes it's not going to be successful. So the alternative to that is a 2-stage deal. So technically a 2-stage deal is an outright sale. I mean, you do turn over your practice. You do, in fact, start relinquishing control of your practice pretty much immediately, but we do it over a longer period of time. And the things that are going to change that affect the client relationships and so forth, the staff relationships, are happening in a much more gradual manner. So the first stage is stage 1, and usually that lasts for up to 5 years. And during that time, the seller is still working. Is basically from from externally, it looks just like a merger. And so the seller is now becoming a partner in the firm that they're merging into. They're usually not an equity partner. Normally it's a contract or non-equity partner, although it's not important for clients to know that. So you merge into the buyer's firm, you start the transition process, you start introducing your clients to who their successor is going to be, you give it time, and you maintain reasonable control over the client. So everything pretty much stays the same. You know, you may move into the buyer's office, you may not. That's not really as important as, you know, what happens with respect to the transition. And most importantly, because you're maintaining a full-time role in the firm, and because your purchase payments are not going to start until stage 2, you're able to maintain your compensation level typically. As long as your client base stays intact, as long as your commitment of time to the practice stays intact, then you can maintain your compensation level in most cases. Then stage 2 kicks in, and that's basically the buyout phase. So say we've started stage 1, we've got a 2 or 3 year stage 1. After 3 years, now we start the purchase payments. And now it makes sense for the buyer to pay you those purchase payments because you're no longer working full-time, if at all. It's not unusual for, in this situation, for the seller to be involved in a part-time role ongoing, but typically on like a per diem type arrangement where you might get paid based on your productivity or something. The key to this, though, is that the beauty of it is that the practice has effectively already transitioned to the buyer during stage 1, and so the risks associated with transition, the decisions you're asking your clients to make and staff to make about the new buyer, you've been a part of making happen. You've been a participant in making happen, and typically, now that your role has changed or completely been eliminated, it's a non-event for the clients and staff. They've already made the decision that they're okay with this. A cull-out sale is, in essence, selling off a part of the practice, or selling the practice but keeping part of the practice, or in some cases, you know, just breaking up the firm altogether. So examples of this would be let's say you've got a wealth management practice along with your accounting and tax practice, and you want to keep the wealth management practice but sell off the accounting and tax practice. We're seeing that happen kind of on a regular basis now, because wealth management typically doesn't require a lot of face-to-face time. It can be done off-site. You can actually probably move to Arizona or something and keep that part of the practice, and oftentimes it's pretty lucrative. So we're seeing people that have those kind of practice sell off their accounting and tax practices. Now, one of the issues, of course, is if you sell to a firm that does wealth management, they may not be too interested in you maintaining that outside of their practice, because that may have been the reason they wanted your clients in the first place. But that's just one example. Another example of this would be a firm I worked with in the Midwest. It was about a $7 million firm. And they had a practice, they had an office, a satellite office that was about 200 miles away from their headquarter office in a much smaller town. And it was about $1.2 million volume. It had one partner in it. Nobody in the practice wanted to move to that town. And so they were facing a succession issue, but it was one that was only in that one satellite office. So what we did was we found a buyer for that office, and basically someone who could execute a succession plan for this partner, and that would in essence be a cull-out sale. And then of course, you know, some firms get to the point where their succession issues are so acute and they're so ill prepared to deal with them that rather than pretend they can do that, and because they can't get together on exactly what the path for each partner is going to be, some firms break up or break off a couple partners to go take care of their succession issues differently than the rest of the firm wants to. That's another example. So what's the difference between a sale and a merger? Well, in essence, it's the ownership status of the seller after the transaction. So in a sale, you're basically selling the practice in a two-stage deal. You may actually have a title of partner. You most of the time are not going to have any equity in the firm that you've sold to or merged into. Whereas in a merger, the partner is going to basically exchange equity in their firm for equity in the new firm. So that's the distinction. It's not unusual for combination deals to happen, where some of the partners will be in essence selling their interest in their firm to the buyer, and some of the partners in that firm will be merging into the buyer. But the difference is, of course, the ownership status. So when you think about what is my practice worth, and you're thinking about merging in a true merger where you're going to have equity in the new firm, that firm's owner agreement is what dictates your value in essence. And it can be different from firm to firm. So if you talk to 3 firms and you talk to one that pays 2.5 times comp as their buyout formula, and another firm that pays on some kind of a unit basis or equity method basis times a theoretical value for the firm, then those could be dramatically different. And when you think about what's my practice worth, well, obviously their agreement is going to dictate what your interest in your firm is. So if we use that understanding and go back to our case study, we have a combination deal here, and it's driven by the fact that Frank is only 3 years away from wanting to retire, and Alice is indefinite and probably at least 10 years, and Dan, we're not sure because of the size of practice he has and his, whether he's strong enough to actually be an equity partner in the new firm or not. So what ended up happening was that we negotiated for Frank a 2-stage deal. We negotiated for Alice a pure merger, where she in essence signed on to the new partner agreement of the firm she is merging into. And in Dan's case, because we weren't sure about whether or not he had what it took to be an equity partner, he came in as an income partner, and we set aside the equity interest that he had in his firm. The value of that, we set that aside in kind of a limbo situation, and down the road, if he becomes an equity partner, we can convert that to a contribution to the equity of the firm, or if he doesn't become an equity partner, then eventually he'll get bought out for that interest. So this is an important detail in this case because we have 3 different deals. Frank, it turns out that we were able to associate because they weren't run really as a one firm concept. They really did have distinct books of business, and they kind of made sense with the value that was being ascribed to each of them. We were able to tie their books of business they were managing to their deal. Now, in some cases, that's not the case. So we might have Frank owning 70%, but he's only managing 20% of the business. And, that makes it more complicated. It's something we can't overcome, but it just makes it more complicated. So the reason why I wanted to bring this up is as I go through the details of the valuation for each of these, I wanted you to be able to understand that we could tie the value back to their books of business. So, again, Frank's buyout and Alice's equity will be tied to their books, and Dan will either become an equity partner eventually or be bought out of the equity he had in his old firm. So Frank's 2-stage deal looks like this. First off, we have a contractual hard stop on his stage 1. That's so that he's not just sort of hanging on. It creates certainty, and that's usually the case with 2-stage deals. Stage 1 normally has a date when it has to end no later than. It can end earlier if the circumstances warrant, but it can't go beyond that date. Frank's comp, in this case, if you go back to the data, and if you have the slides, you can do this. Frank's comp turned out to be about 35% of the book of business that he was managing. So we tied his comp directly to his book of business. And therefore, he's making 35%. He'll continue to make 35%. If the book goes down because he loses clients, then his comp goes down. And we also had a factor in there that if he used more labor than he had historically used to manage that book of business, there'd be an adjustment in his compensation as well. So his primary objectives during stage 1 are transition the clients, make sure they stay after the merger, make sure that he is making introductions to a successor, which of course requires that the merging firm identify who that's going to be. And of course he wants to maintain this level of income that he historically has had. So what happens specifically on the buyout is that he gets to keep the portion of his, when I say retained AR and WIP, that's what mostly made up his capital. So he gets to keep the 70% of the $850,000 or $800,000 that the firm had in capital. Increasingly, we're seeing firms delay the payment of that. We're saying, yeah, you get to keep it, but we want to use it for a while. And it wouldn't be unusual for Frank, in this case, to leave it on the table even for the full first 3 years of stage 1. But you know, it can be either, look, don't even bother bringing it in, or you know, as we collect it, you can have it, or like I said, increasingly we're seeing that be delayed. The buyout was based on collections over 6 years. Now, I will tell you that as firms become larger, the selling firm becomes larger and the buying firm becomes larger. Typically, deals like this are becoming less and less tied directly to collections for the whole payout period. It's not unusual for us to see maybe a look back be as short as 2 years. And the reason for this is because I think in larger firms, on both sides, you have more of an institutional relationship with clients. It's not quite as personal as it is with a sole proprietor. If you're in a $500,000 practice and you're a sole proprietor, your relationships with your clients are extremely personal, and there's a lot more risk associated with the transition as a result, and so buyers tend to look more toward, you know, this is one of the trends that's happening in the merger and acquisition area, is that retention deals on larger firms are starting to kind of shorten somewhat. And then, of course, Frank was also given a new business bonus for any new business that he generated, because that wasn't included in the buyout. So there was typically, you know, will typically be some kind of commission program for new business that he generates to motivate him to do that. So we're going to jump off here for a second for another polling question. Nikki?
Okay, the third polling question is on the screen. This one is, which best describes your personal situation over the next 5 years? And your options here that you're going to reduce your role and your time in the practice. Maybe you have partners reducing their role. You're planning to acquire another firm, or none of the above. We'll give it about 5 more seconds. If you haven't selected your answer, please do so. And again, this is the third of 4 polling questions, so we'll have just one more after this. Okay, I'll go ahead and close the poll. The results are pretty even. Nobody selected that having partners reduce their role, but the other 3 are fairly evenly split.
Okay. All right, let's talk about value. There's 3 questions that always come up. The first one is, what is the multiple? The second one is, what is the multiple? The third one is, what is the multiple? What are practices going for these days? That's the question. What are the multiple? What is the multiple? And I can tell you that, you know, there clearly is a trend for multiples to come down. And the reason for that is that it's just supply and demand. There are many, many more sellers relative to buyers than there were 10 years ago. And the other thing that's happened is the economy has strengthened, and as a result, buyers, firms that are interested in buying, are growing on their own. They don't need merger and acquisition as much as they did back in 2008 and 2009 when the economy was tanking. The only way to continue growth was to do a merger or an acquisition. And the second thing is that there's a talent shortage, and so firms are asking themselves, how much of this can I do when I'm having trouble hiring people for what I already have? So, you know, those combination of things are creating buyers that are a little more picky, not quite as enthusiastic about, you know, doing every deal they come across, and there's many more sellers because of the demographics. So there is definitely a trend downward on multiples, but there's definitely 2 things to consider here. First, the value of your practice is because the value is almost all goodwill, or, you know, whether it's technically called goodwill or not, that's in essence what it is, blue sky. It's based on your client list, and it's based on, for the most part, your ability to transition your duties and your relationships as a seller to a buyer. And so the whole thing is based on what kind of business plan is there that backs up that transition, how successful will that business plan be, and that's where you go back to the 2-stage deal and say, the most important thing for me right now to focus on is making sure that I'm talking to someone who can successfully take over the practice, and I help them do that successfully. So that's the first thing to keep in mind. But the second thing also is that the deal terms will also have an impact on the multiple. So how the terms are structured in the transaction should have a direct impact on the multiple. And there are 5 primary factors involved. The first one is cash up front. You know, the deals that we see for the most part, when there's an outright sale, usually don't have any more than about 20% cash up front. So somewhere between 0 and 20, and there's a lot more deals at 0 than there are at 20. I know there's transactions out there with much smaller firms. They get arranged with, you know, SBA loans backing them up and so forth, and we're not usually involved in that kind of stuff. But those typically are for very small books of business, mostly tax practices that are under $500,000 in size. So for most of the deals that we see, the cash up front is not going to be significant. But there are other issues associated with this that you need to take into account. So, for instance, if you close a deal in December, what's going to happen during the next 4 months? The buyer is going to realize a lot of profit. And so a buyer would be much more motivated to increase a down payment and accept some of the issues associated with investing in the purchase, other issues. If their closing's in December, then if it's in May and you just took out what might be in some cases 60 or 70% of the profits in that practice during the last 4 months. So that has an impact. You know, of course, the deal's cash flow to the, you know, how seasonal your practice is has an impact on this as well. And then the accounts receivable issue comes into play as well. And one of the things that sellers tend to forget, when you sell your practice, you normally do, in fact, retain the receivables. You did the work, you did the billing. The fact whether you've collected or not is still your asset. So it's normally the case that you will retain the value of that. But what sellers tend to forget is that when they keep that money up front, which they oftentimes do, the buyer is going to realize little to no cash flow for as much as 2 or 3 months after that. So in effect, there is a form of down payment that's being made by the buyer having to undergo all of that negative cash flow. But you know, sellers sometimes tend to forget that. So as a result of that, as I mentioned before, what we're seeing a lot of times now is buyers asking sellers, can we hold on to that receivable for those receivables? We'll collect them for you. It's still your money. I'll pay it to you 6 months from now, or I'll pay it to you a year from now. I'll pay it to you 2 or 3 years from now. I'll pay you monthly over the next 2 or 3 years, something like that. So that can help make the deal work better for the buyer, and also, you know, not really giving up anything. One of the things to keep in mind is most accounting firms that we work with don't have a lot of debt. In fact, many firms never have debt. They hate debt. And so when they do a merger or acquisition, oftentimes they're going to create debt. They're kind of averse to that. So one of the reasons why they push back on some terms is because those terms are going to result in them having to borrow more money. And that's something that culturally they're just not used to doing. The second issue is the retention clause. There's almost always going to be a retention clause. I don't care, even if you do a deal that's got an SBA loan associated with it, you're probably not going to get more than 80% or 70% of the proceeds up front. So there's always going to be a retention deal. So those come in different forms. A collection deal is one that's based on all the payments over a period of time are based on collections during that period of time. So go back to Frank's deal. It's a 6-year collection deal. He got 16.67% of the collections for the first 6 years from his book of business. You know, fixed deals are rare. I hardly ever see them. In fact, I've never actually seen one. I've heard about them. But, you know, something that has no retention clause at all creates so much risk for the buyer that it just is untenable. You know, what we do see instead are what we call limited guarantee deals, where we might lock in the price after 2 years or after 3 years. There might be special clients that are set aside that have a different kind of retention associated with them. For instance, let's say we've got a practice where half the business is in one client. We might have a limited retention deal for the rest of the practice, and then a collection deal for 5 years or something on the portion that is associated with that one client. One of the things to keep in mind here, sellers hate retention adjustments. They feel like it's out of their control. And so sometimes they're fighting hard to reduce the retention or even get rid of it. But keep in mind that what the message you're sending. The harder you fight on that, what you're basically saying is, I don't think you, the buyer, can keep my clients, and therefore I don't want to have my deal associated with that. But if you think you can't keep your clients, why would the buyer think they could keep their clients? So you've got to be careful that the message you're sending, and rather than fight that retention clause, and I'm not saying you shouldn't try and negotiate a deal, it's better to think about what can we do to work together and make sure that we both do keep those clients. The third term is the profitability of the practice. Now, obviously, you want to start with what the seller's profitability is. The real issue, though, is understanding that it's the buyer's profitability that drives the value of the deal. So, sometimes there are things that you can do that have a negative or positive impact on the buyer's profitability. Everything that you ask the buyer to assume from you that the buyer doesn't want to assume has a negative impact on their profitability. So, for instance, Sally, your office manager who's making $100,000 a year and is probably only worth $60,000, that creates, in the buyer's mind, a negative profit of $40,000 if they have to keep Sally. A lease that they have to keep that they don't need creates a negative profitability factor for the buyer. An example of how this changes is, let's take a really extreme example here. You've got a sole proprietor who's got a $300,000 practice, works out of his home. His wife answers the phone. He's making 80% profit. And then all of a sudden he decides that, I don't want to work out of my home anymore. My wife doesn't want to answer the phone anymore, and I want to take a little more time off. So he moves into an office and hires a staff person, and all of a sudden his profitability is 40%. At what point in time was that practice worth more to you? Obviously, his profitability at 80% is a misnomer, because that's not how you're going to operate the practice. Another example of an effect on profitability is the tax structure of a deal. Deals generally fall into two categories: one that requires amortization of the practice as an intangible using goodwill, and the other is a deal that's deductible as paid. Oftentimes in deals that are paid over short periods of time, say 5 years or 6 years, they're paid as consulting agreements, so they're deductible as paid. When you get into payout periods that are longer, 10 even longer years, then you start seeing maybe more use of a deal using an amortization of the intangible. So, if it's important to you when you're selling your practice to get capital gain treatment, think about period, which will help the buyer not have a negative cash flow from the terms. The fourth area, of course, is the length of the payout period, and it's not unusual at all for payments to not have interest associated with the deferred payments. So even in a 10-year deal. That doesn't mean you don't have to impute the interest if you're dealing with an asset sale, but typically it's not an add-on. So the longer the payout period, the better the cash flow, obviously. So the multiple is the effect of all of those different terms. So the lower the down payment or the upfront cash required, the longer the payout period, the higher the profitability, and the longer the retention guarantees are, you should expect a higher multiple. So when you think about how to negotiate a deal, and you think about, what am I willing to give up to get that? If it's really important for you to have capital gain treatment, you may have to accept either both a longer-term payout period and maybe a smaller multiple. It's not unusual at all for a deal that's 100% deductible as paid versus a deal that's 100% an asset deal to have as much as a 20% differential on the multiple. So we get back to Frank's deal. And this, remember, it's a two-stage deal. Now we're talking about stage 2. How did Frank actually get paid for his practice in stage 2? Well, there was no down payment, and that's not unusual in these kind of deals. As I mentioned before, he got paid over 6 years, a 16.67% of collections for the first 3 years, and the price locked after 3 years, and the remainder was paid based on what his collections, or what the payments were in year 3. The deal was treated 50% as an asset sale, so that portion was capital gain treatment, and 50% as a consulting agreement. That was a compromise between the buyer and seller to give Frank a little better tax treatment. So in essence, Frank got 1x of his managed book of business, 6 times 6.67%, 16 points. Partner agreement, and she was conditionally guaranteed for the first 2 years after the merger $275,000 of comp, which is what she was making prior to the merger. So, the guarantee is not to protect Alice from economic calamity, in other words, losing all her business. What it's really designed to do is to protect her from the vagary of what the new firm's partner agreement would be. So after the 2 years is up, she will be a partner like any other partner, and she'll be valued and paid just like any other partner. And so it's important for Alice to understand what might happen if all things remain the same with her with respect to how she might get paid in the new firm. Obviously, if because of how they pay partners, her comp would reduce dramatically under the firm's compensation arrangement, that's something she would have to. That's not the case as part of the due diligence you do, and you can determine that that's not going to be the case. But in order to keep her comfortable that, because she doesn't know how the new compensation will work for her, compensation system will work for her exactly, we'll give her this 2-year guarantee. She received 8% of the equity in the new firm, which was her pro rata share based on her book of business. And she contributed her portion of the AR and WIP as a capital contribution to the new firm. Dan came in, as we said, as an income partner. His compensation, again, was pegged at what it historically had been. And one thing I'd throw out is if you're thinking about acquiring firms, it's really difficult to ask people to merge into your firm to make less money. So most buyers will offer some kind of terms that keep the merging firm whole with respect to compensation. If that's not your goal, I'll tell you, it's difficult to find people to go through with the deal. He'd be eligible for bonuses consistent with the other income partners in the firm. The AR and WIP would have been retained by the successor, but it's set aside as something, it's money they know they owe him down the road. If he's not made an equity partner within 3 years, he'll be paid for that AR and WIP, and maybe even be paid for his portion of the book of business. I would say that's less certain, but maybe in a little over half the time with that size book of business, he probably would get something down the road for having contributed it. And oftentimes also may matter how he came upon that book of business. Obviously, if he developed it on his own, it may be different than if he sort of inherited it from the other partners. If he is made an equity partner, then the AR and WIP would be considered contributed capital. This is our third and final polling question, Nikki.
Great, thanks.
Sorry, fourth, yeah.
That's okay. It's on the screen now. This is what your firm's most likely succession plan looks like. So here your options are finding an external buyer or an upstream merger, an internal solution, you prefer not to sell or okay. Looks like we've got nearly everyone. I'll go ahead and close the poll. Just over half said an internal solution, 27% finding an external buyer, and the remaining 20% aren't sure what their firm should do.
Okay, good. Well, one thing I would point out to you is that I've done several webinars this year on internal succession planning and owner agreements. If you go to our website, you can download those webinars. You can't get CPE credit for them, but you can actually review the exact webinar that I gave. And of course, we have a lot of other material on our website with mostly articles that we've written for the Journal of Accountancy on these issues. So if you're interested in pursuing internal succession as an option, then you might be able to get some guidance from all that material on our website. And of course, I'd be happy to talk to you about your situation if that's what you want to do. So when you think about defining the right successor for your firm, the firm you should merge into, think of the 4 C's: culture, chemistry, continuity, and capacity. Culture, when people talk about why deals fail and why they succeed, the number one reason they always say is culture, but then people have a hard time defining what that means and how to measure it. So, there's always the look and feel. When you walk into an office, you get a feeling for how they operate and how they're different than you, and you can tell from talking to them what their value system is, and all of those are indicators that you should consider. But I think the best way to actually get your hands around this is to ask yourself 3 questions. What's it like to be a client in this firm? And of course, compare that to what it's like to be a client in your firm. What's it like to be an employee in this firm? as opposed to your firm? And what's it like to be a partner in this firm as opposed to your firm? So for instance, as a client, how are the services going to be delivered to me? How am I going to be billed? How much am I going to be billed? What kind of interface am I going to have, and who's that going to be with? If I'm used to working with a partner, hands-on, face-to-face, you know, in the firm that you merge into, all of a sudden you're going to be working with a staff person for the most part, a non-partner. That can change the client experience dramatically. And so there's a cultural difference between those two, and it's something that you can pretty much get your hands around. You know, as an employee, how much time what kind of hours am I expected to work during tax season? What kind of hours am I expected to work overall? You know, am I going to be able to be mobile? If I'm used to working outside the office or working from home, and I merge into a firm where those things aren't allowed or aren't very common, that can change the employee experience, as well as obvious things like compensation and fringe benefits. And then as a partner, how much accountability do I have? You know, what kind of chargeable hour expectations do I have? Is this a firm that measures, that values, for the most part, practice development when that's not something that I do a lot of? I mean, how's my partner experience going to change? So that's how I think it helps you to get your hands around culture. Chemistry, just ask yourself this one question. After your first meeting, the people that you sat across the table from, is this somebody that I'd want to have lunch with on a regular basis? Did I enjoy this person? Did we have good chemistry? And if you didn't, don't go forward with the deal. Why would you think that if you didn't enjoy working with them, your clients and your staff would? So, you know, your clients and staff are with you because of who you are. And if it's, you know, if the person across from you is so much different than you that you can't imagine yourself spending a lot of time with them, why would they? Continuity is, you know, to what extent are the operations going to change? And the thing again there is, we like to think about things that happen in front of the door, your front door, things that happen behind your front door. The things that happen in front of the door are basically defining the client experience. So to what extent is the client experience going to change, and how fast is that change going to happen, and how important is that going to be to your clients? Needless to say, if you're merging into a firm where client fees are going to go up dramatically, that's a problem. So that's an obvious one. But there are other things as well. Think about the things I talked about up above in the culture issues. Behind the door are the things that happen that are important to the operations, but the client doesn't know. So the client doesn't care what tax software you use to prepare a tax return, but it can make a big difference, obviously, to you and your staff, because you've got to train on the new software. I'm not saying you shouldn't expect to do that, but just keep in mind that think about the changes that are going to affect the clients and the things that are going to affect you and your staff. And then capacity. You know, the reason why a lot of times firms are merging up, of course, is for succession. So someone has to be able to replace the people that have a succession issue. You want to make sure that the firm has the capacity to do that. And again, it's not that they have the person in place right now, if you're 4 or 5 years out from retiring, but do they have a process in place? Do they have an understanding of how they're going to address that when the need comes up? You know, you are what you are. Proverbial, can't put lipstick on a pig. However, there are things you can do to dress your practice up. So one of the things to keep in mind here is buyers hate inheriting problems and poorly run practices. If you've got AR and WIP that has agings on it with stuff that's on there that's 2 years old, get it off. You're not going to collect it, and if you are, you know, go about it doing it without providing the firm with an aging that looks like your clients are deadbeats. You know, present your partners and staff in a positive light. I had a firm I worked with recently where the managing partner was the one who had the initial meeting with the potential firm he was merging into. I don't know why he did this. I guess he thought if he made himself look good, that he'd come out better, so he kind of ran down his partners and staff. And as we got into the deal, this firm never forgot about what he said and basically said once they realized that he was pretty much a short-timer, there wasn't anybody there to actually shore up the practice. They didn't do the deal because of something he'd said about his partners in the first meeting when, in fact, he'd way overstated the issue. You know, consider jettisoning problem staff. Buyers hate to hear, gee, I'd get rid of Sally, but I don't have the guts. Can you do it for me? That doesn't work. Clean up your office, eliminate clutter, provide good time records. Smaller firms have a tendency to not keep track of specifically partner time very accurately. Some of them don't keep track of any partner time. Everybody in the firm records time except the partners. Or they keep track of only their billable time and no non-billable time. Most larger firms run their practices through a time and billing system. And when they can't tell from your time and billing systems how you're running your practice, it can be unnerving. And be willing to part with unprofitable clients, clients that are, you should get rid of. Sometimes that can make your whole practice look bad. So I'm not saying you have to fire them ahead of time, but recognize you have some clients that maybe you'd be willing to part with, and be willing to have that conversation up front. There are 7 steps for how to actually manage your deal, the process. And these are the 7 steps. Let's talk about each of those for a second. First thing you want to do is put together a description of your practice. The metrics, the obvious things are how large the practice is, what services you offer, what % of your practice is audit, what % is tax, and so forth. What your billing rates are, especially for your partners, but also general rates for your staff. A description of your staff, how many you've got at what levels, how much they're paid. Be willing to talk about the profitability and so forth. We actually have a practice summary. I'd be happy to send you a copy of what that looks like if you send me an email. Lease issues. Make sure you've got that in the description of your practice. How large the lease, what the monthly payments are, and what the expiration is. Technology issues. Talk about your tax. If you're paperless, mention that. If whatever tax preparation software you're using, mention that. That tends to be not real critical, but somewhat important. What the goals are for the deal. Why are you pursuing a merger? What are the individual goals for the partners? Sometimes they're different. So this partner wants to work another 2 or 3 years, and these partners don't know, they're younger, they don't care. What the age of the partners are and staff, if that's important, and then what success looks like for you. Organize your must-haves. Location. Keep in mind that if you say you have to keep my space, my location, you've eliminated probably something like 70% of the potential people you could be talking to if you didn't have that must-have. Now, if it's because your clients and staff are geographically sensitive, fine. It's a must-have. But if it's only because you don't want to move because you just like where you are and it's convenient, you've really limited your options if you say you have to keep my space. Of course, partner retention is an issue, compensation issues, and I'm not willing to take a step back in compensation while I'm working full-time. Technology issues, you're talking to a larger firm, there's a decent chance you will be. So you may say, I'd rather not have to make that change, but again, most larger firms only would require that. Every staff person you say you have to keep, most firms don't want to lose staff. They want your staff, but if you make it so you have to keep so-and-so and so-and-so is a misfit, that can be a problem. Name is really not important. Describe otherwise. What's my role in the new firm, even though my name is no longer in the name of the new firm. And things you can be more flexible about. Have your initial meetings. Share the information you put together on your summary. That's hopefully, in fact, maybe has been exchanged before the first meeting. Focus on talking about the 4 C's. Discuss what success looks like and narrow the field down as quickly as you can. Ideally, you talk to more than one firm. It's usually the case in larger markets we're able to arrange somewhere between 3 and 6 meetings, initial meetings with different firms, in order to get a good gauge of what's available. So it can't always be the case in smaller markets, but in larger markets we can usually do that. Ask for a non-binding offer. One of the things I hate seeing are firms that have 4 or 5 meetings before they ever start talking about a deal. I think the most you should ever have before you actually talk about some specifics around deal structure are 2 meetings. If you're a sole proprietor, maybe you can do that after the first meeting. If you're a multi-partner firm, then oftentimes it's important for all the partners to meet the potential buyer before you get an offer. But make sure that you do that as soon as possible. And you can refer back to this slide, we're running out of time, that you should be doing due diligence on the firm you're merging into. They'll have their own list, which is much more comprehensive, but this is stuff that you need to find out about them. And finally, the contract. 2 things I want to point out. Don't ever use a contract to negotiate terms. If you're going to have to make a change in the terms, at the contract stage, talk about those changes before you send a red line back that says, oh, this deal just changed a whole lot with this red line. That's a great way to kill the deal. The second thing is make sure your lawyer is one that's going to help you make the deal happen as opposed to one that's going to break it. Lawyers that help make deals happen understand their role is to negotiate the terms, the legal terms of the contract to protect you. Lawyers that tend to break deals are lawyers that want to renegotiate the basic terms. So they want to turn your 3-year retention deal into no retention, or they want to get a bigger down payment or something like that. So if your lawyer is trying to do that, he's probably not very helpful. For more information, I suggest you go to the AICPA Succession Planning Resource Center. We had a big part in building that. We're not the sole author of it, but it has a lot of information on it. Here's a series of articles that you can get from our website that talk about issues related to succession and mergers and acquisitions. This series of 12 articles that we wrote from July of 2013 to 2014 ran 12 consecutive months, and then later that year we ran another series of 3 months strictly on valuation issues. And the CPA Consultants Alliance is a group of consultants that I'm a member of that has written, we wrote a book that you can get on Amazon about strengthening the connection between different generations, and then we also have 3 white papers you can download from our. Here's my email, and I'm going to turn it back to Nikki to wrap things up.
Great. Thanks so much, Terry. Thanks, everyone, for attending. As I mentioned before, your survey will pop up right after I end the session here momentarily, so do wait. The articles that Terry referenced there at the end will come to you as links in the follow-up email that you'll get in about an hour or so. If you have any questions regarding CPE, reply to that message. It'll come to me. If you have any questions about content, feel free to reach out to Terry, and his information is there on the screen. Thank you all for attending, and I hope you have a good afternoon. Bye-bye.
Thank you.